welcome to another edition of ChartYourTrade.com's free webinar series. I'm your host, Michael Ahmad. I am the founder of ChartYourTrade.com, and today we're going to learn how to identify market health in 3 steps, part 2. With us again is keynote speaker Adam Sarhan. Adam is the founder and CEO of Sarhan Capital, which is parent to FindLeadingStocks.com. Without further ado, here's Adam.
Another tactic that I like to use to determine the overall market condition is to say, okay, what happens here with respect to price and moving averages? Now, there's lots of different moving averages, and all moving averages it's just a way of smoothing out price action. So if you take the 50-day moving average, which is the most common moving average, it's the last 50 days, the closing price, a simple moving average. The last 50 days, take the closing prices, and you divide by 50. That's it, and you draw a line. Now, if it's an upward sloping line, all things being equal, that's healthy. If it's a downward sloping line, it means that the market's moving lower, and that's typically unhealthy, all things being equal. Now, there's other moving averages. People use 9, 18, 21-day moving averages, 10-day moving averages, 150-day, 200-day, ... It's all the same thing. It's just a simple calculation. The last X number of days divided by that number, and then you draw the line. So the idea is that there's 50-day moving average, just for whatever reason, really because everyone looks at it, has emerged as the norm. And that 50-day tends to be the money magnet, as a good friend of mine calls it, meaning that the market pulls into the 50, almost always. And then what happens is it bounces back again. Now, in a healthy uptrend, if you see a big gap between the 50-day moving average and the price, I call that an air pocket. Expect the market to move down a little bit. If you don't, you see it hugging the moving average, and all of a sudden it's getting ready to break out. That sets the stage for a nice move up. So really, just ask yourself, are we overbought? But realize, overbought markets can get a lot more overbought, just like oversold can get a lot more oversold. It's just a secondary tool to use, but be mindful so you don't end up chasing stocks. Where is the market? Where is my stock compared to its 50-day moving average? That's it. Now, moving averages versus other moving averages. A death cross is known as a 50-day moving average crossing above a 200. And then a death cross is when it crosses below it, and then a golden cross is when it crosses above it. So let's just repeat for a second. A death cross happens in an uptrend when the 50-day moving average undercuts the 200-day moving average. A golden cross is when the 50-day moving average goes above the 200-day moving average. And the death cross, it doesn't take rocket science, is typically bearish. Golden cross is typically bullish, but again, it's not conclusive evidence. It just tends to be one piece of the overall puzzle. Another way that I like to look at the market and say whether or not it's extended or not is if I see a big air pocket where there's a gap between the price action, you had a big rally off the 50 and the 50-day moving average. In other words, the S&P is 50, 60 points above its 50. And then I look at the number of stocks in the S&P, the percentage of stocks that are trading above or below the 50-day moving average line. I've noticed over 75, 80% of the time when you see that number hit over 80, you're ready for a pullback. Not always, but more or less. And when you get down to the 30s and 40s on the other side, you're ready for a counter-trend bounce. So again, just to understand that percent of stocks above and below their 50-day moving averages, if you look at all the stocks in the S&P, you can see how many of those stocks are trading above their 50s, how many are below their 50s. For whatever reason, it just happens to be a secondary tool that I've found that tends to be consistent. If you have the percentage of stocks in the S&P above 75 or 80 that are above their 50-day moving averages and the market itself is above its 50-day moving average by a large, big air pocket, which I call it, you tend to be setting up for a pullback. Now, again, part of that whole rationale of keeping it simple is just keep it simple. Don't worry about these excessive labels. Lots of people out there have their own quote-unquote systems, and they're this day and that day and counting the days and undercut this and all these rules that just convolute your ability to make intelligent, objective decisions. Typically in the media, and these aren't my definitions, there's only 3 real things that can happen in an uptrend. Either the market pulls back, and that's defined objectively by a decline of at least or from 0 to 9.9%. So basically under a 10% decline off of a high. That's a pullback, and that's healthy. Corrections also every now and then are healthy, and that's defined by a decline of 10 to 20%, more or less. If you're at 20 or higher, by definition, you're in a bear market. So corrections 10 to 19.9 to be exact. Bear markets over 20%. Now, that's the standard definition. In bear markets, it's the exact opposite. So keep that in mind as you label these markets. You're looking at the market, well, are we in an uptrend, a downtrend? I've seen people say that the market's in a correction when the S&P is down 2% from its all-time high. So it's when you shift your focus to anticipate these pullbacks and realize they're healthy, then all of a sudden your mentality shifts. You're not fearful anymore that these pullbacks are going to occur. And instead, you're optimistic, you're looking forward to them, and you step up and do the buying. Instead, the novice is selling into those pullbacks and getting shaken out. You have the discipline, the foresight to say, okay, I know pullbacks are healthy, I'm going to step up and buy. So actually a good saying on Wall Street is that the stocks take the stairs up and the elevator down. So just be careful. Once stocks start going down, they fall much faster than they go up. Another idea of my methodology or the investment system that I use is to step up and buy weakness and uptrends, not just buy strength. Most people say, I'm going to buy the breakout. Well, what happens is there's a gap in between of where you're buying, and you end up getting stopped out from a normal healthy pullback because of all those things mentioned before, the air pocket, this, that, and the other thing. So what happens is just understand that leading stocks pull back, and if it's a healthy pullback, the market pulls back. If it's a healthy, shallow pullback, step up and do some buying. Don't just chase it and buy those breakouts, because invariably most breakouts just fail. It negates the breakout, and then it works, and then you're stopped out for a loss, and it's very frustrating. So after years of just having that not work for me, I had to go back and forget everything I learned and then reteach myself what actually works. Roll up my sleeves, analyze the market based on what's actually worked for me, what hasn't, and these are the conclusions or the lessons that I've learned from that long introspection or that long fact-finding mission that I was on. The fact-finding mission was just how to really make money trading stocks and investing in the market. The other idea is don't chase the market. If you had a big move and you missed it, that's fine. There's nothing wrong with missing it. Be patient. Wait for that pullback, and pullbacks always happen. Period. I mean, it's a fact. Just like you go to bed at night, the market will pull back. So if you find that urge, oh, I need to get in, I missed it, I can't let it go higher without me, and the next day it goes higher. Oh, I can't let it go higher without me. The next day it goes higher, and then all of a sudden you give in, you buy it. It's not disciplined. All of a sudden it pulls back, and then boom, you're stopped out for a loss. You chased it. You get stopped out, you lose money, it has a normal healthy pullback into whatever moving average or prior chart highs, whatever it is, an uptrend line or whatever, and then boom, blast off without you. So be disciplined, really, really focus on not chasing stocks and or the market, and realize, ask yourself, is the market extended? And then keep in mind, the markets can get more extended before they pull back, but they always pull back. If not, they consolidate. They move sideways or they pull back, one or the other. Now, price is primary. For me, everything else is secondary. People ask me all the time, what about volume? Volume's secondary. There's nothing wrong with the market rallying on light volume, period. It's just there's nothing wrong with it. If you ask me, the S&P went from 1,700 to 1,800, and every day was low volume. Does it matter? It went from 1,800 to 1,900, every day was low volume. So what? Price is what matters. Now, obviously, you want to see volume. The more volume helps institutional buying, institutional sponsorship, but it's secondary. It's not a primary factor. Back when I first got started, I was learning someone else's rules, and they said you have to have at least X amount of volume above average in order to buy it. So I didn't buy it because I saw a stock break out. It was Baidu back in the early 2000s, and the stock had a tenfold move. It missed it because it didn't have the volume. And it happened to me so many other times. So right away I said, okay, volume just for me, it doesn't matter, period. And I'm especially because I'm using these advanced entry points, so I'm getting in before everybody else gets in. So really, whether you use a classic breakouts or the early entries or whatever the case may be, just understand price is what matters. You get paid and you make money, you lose money based on only one thing. The difference in your statement every month between, or even every day, between what you entered and what you exited. And that's based on price. Now, whether you got it at 10, you sold it at 50, the statement doesn't matter. If it has volume, if it has fundamentals, if the news was negative or bullish or bearish, it's all second. It's all noise. The only thing that matters is the price. So when you analyze price, that really gives you a big upper hand, because most people tend to avoid that for whatever reason, and they look at other things and they get confused. So just keep it simple. Realize too that there's nothing inherently wrong with a low volume advance. I mean, it's okay. There's nothing good or bad. It's a neutral event. So here are the fundamental. Those are the technical tools I use. Here are the fundamental tools that I look to look at. And for me, these are very helpful. But most people use fundamentals, in my opinion, the wrong way, because we'll get there in a second. Markets are counterintuitive by nature. They're out there. It's just the way that it is. Most people make emotional buying decisions. Fact. in the market or out of the market. You go buy that, new sports car, you go buy dinner, you go buy that shirt, or whatever the case may be, that stock, enter, buy item of choice, Starbucks coffee, whatever it is, it tends to be, not always, most people, they tend to make emotional decisions. It feels good to buy. There's retail therapy that they talk about, where they say spending money in general, for men and women, tends to be an antidepressant. People feel good when they spend money. It's just a fact. So when you buy stocks, it's the same thing. So there's that, you're not making a rational decision. Understand it's a highly emotional decision. Plus your money's on the line, and most people love their money, and it's an emotional connection to their money, and they don't want to lose, and then they end up focusing on not losing, and then they end up losing because the law of attraction comes in, and dot, dot, dot. So just understand the concept that markets are counterintuitive in nature. So by definition, fundamentals lag. If I look at what happened last quarter, quarterly earnings are coming out in 2 weeks. They're going to tell me what happened in the last quarter. Well, that's fine and dandy, but the stock market and other capital markets as well look forward. Fundamentals look backwards. So when you learn how to use the fundamentals the right way, they basically confirm or deny your hypothesis or your expectation. So if the market's all of a sudden, the S&P is now at new all-time highs, GDP last quarter was down fractionally. What does that mean? Well, if you're only a fundamental guy, you wouldn't be long stocks because the GDP is down. It's just other metrics also from the economy or for your stock. You're just missing it. How many times have you seen a stock with lackluster fundamentals take off and soar several-fold in price, and you missed it because it didn't have strong earnings growth or strong sales or whatever the other fundamental box you wanted to check? Again, price is what matters. So fundamentals look backwards. The market looks forward. And then when you're able to say, okay, let me step back and realize bull markets begin during recessions. And they end during strong economic expansions, almost every single time. So when you realize that fundamentals look backwards and the market looks forward, all of a sudden you can create a hypothesis based on what the market's telling you. You listen to the market, and then you can see whether or not the fundamentals confirm or deny your hypothesis. And that's how I use the fundamentals in general, whether it's analyzing markets, the macro picture, whatever the case may be, stocks, whatever it is. Now, the next concept here with the market conditions is don't fight the tape. The idea here is to be right. That's what people want, right? Who doesn't want to be right? No, that's wrong. You want to make money. It's not about being right or wrong. It's about making money. The problem is, again, that counterintuitive part of it, most people in life, they just want to be right. In this case, you have to put your ego aside. Really, the market's one of the most humbling mechanisms out there that I know of. And irrespective of how good you were yesterday, last year's performance, or year before performance, your last 10 decades performance, doesn't matter. The only thing that matters is what's happening right now. And the way you can do that is by focusing on making money, not being right. So John Keynes, he's a famous economist, he had a great line, says, markets can remain illogical a lot longer than you and I can remain solvent. How many times have you seen a stock go higher? There's no fundamentals, there's no volume, there's nothing, and you're just sitting there banging your head against the wall. I can't believe this is going up. I can't believe this is going Okay. It doesn't matter. The only thing that matters here is whether or not you're riding that trend, because the market's right, and that's it. Your job is to align yourself with what you see happening, not what you think will happen. So let's talk about sectors and stock analysis. In early 2013, there was all this big media buzz. People were talking about the great rotation out of bonds and into equities. Okay, great. That's fine and dandy. I coined the term, which is the great mini rotation. How many times in strong bull markets have you seen the market just refuse to fall? Earlier this year, we saw that happen where biotechs, momentum stocks, growth stocks all got walloped. They fell 20, 30% from their highs in a very short amount of time, but the S&P was only down 5, 6%. And the Russell, the small cap Russell, and even the NASDAQ was down low single digits. The Russell, I think at one point, the worst it was down 10%. But that's it. The NASDAQ was down 8 and change, and the S&P was down even less. How? Well, if you had such big devastation in so many of these important areas? The reason why was because you had the great mini rotation. In other words, sector rotation came into play. You had a handoff from the biotechs, the growth stocks, the momentum stocks, to utilities, transports, energy stocks. They took the reins, and then that's how they started to rally, and they were underperforming while the biotechs and the momentum stocks and the growth stocks were working earlier. And then it was almost like a handoff, where the bullish ball was handed off, if you will, from one area of the market to another. And that great mini rotation happens all the time. So really, it's important to say what is the overall picture. Are there sectors that are emerging? that are acting well. There's sectors that are basing, and then do they break out and go when the other sectors need a breather? And that's very, very healthy to see that great mini rotation alive and well. And the way you do that, just look at different ETFs, and they're all liquid and they're all available. Now, same thing with leading stocks. Just to refresh, earlier in the conversation, we just had a definition of leading stocks. So there's lots of questions. Well, what's a leading stock? Fundamentals, strong. Again, it's just based on two factors for me. Number one, it's how it's performing based on the other peers. In other words, year-to-date gains. What's the strongest stocks year-to-date? What are the strongest stocks in the last 12 months? Whatever time frame you want to use. And then, how's it performing relative to the market? Typically the S&P 500. And when you find strong stocks that are acting well, that's strong relative strength. Weak stocks that are underperforming, that's weak relative strength. Let's talk about tops and bottoms. I know we're running a little short on time, so we'll go through this in detail because there's a lot of content here. Tops and bottoms. Hands down, I've studied every major top and bottom. Now, I'm not talking about a minor weekly top or a weekly bottom. I'm talking about major shifts and trends. Bull markets at end, multi-year bull markets, multi-year bear markets at end, and then you have a shift, and then a new transition happens. From you move sideways for a little bit, you get that topping pattern after a bull market, and then you move down, and you have a bear market. And then eventually the bear market ends, you move sideways, a bottom happens, and then you move up, and a new bull market begins. So hands down, the single common denominator, every single major top, whether it's dot-com bubble, it was 1929 crash, any other, the '08 meltdown, whatever the case may be, tops and bottoms need time to develop. Well, we'll get into that into the next few slides here. The other thing is to keep in mind valuations get extended near tops. They're over 20. In other words, in the S&P 500, the last few major tops in '08, March, it was actually October of '07. You had March of 2000, and other prior tops as well. We'll see that later on in a few more slides. The PE ratio, which is the price to earnings ratio of the S&P 500, was over 20, 22, 27, things of that nature. Right now, the S&P's PE ratio is 17, 18. So lots of people talking about tops earlier in the year. Understand the valuation still comes into play, but it's important to understand that near tops you have that extended valuation, which we're just not quite there yet. Bottoms, it tends to be low teens or low single digits, and there's different ways to look at the PE. There's 10-year trailing PE, there's just the forward PE, the last 12 months PE, but the most common one is the last 12 months. They call it TTM, which is trailing 12 month PE ratio. Now that's just again a secondary thing. The price is what matters. So also keep in mind there's a difference between a crash and a top. I'm talking about just normal tops and normal bottoms. Crashes obviously happen quickly when the market, by definition, just crashes. It begins with a topping process, believe it or not. 1987, that big crash, began with a topping process. By the time October rolled around, the market had already placed a definitive top, and the major averages were below their respective moving averages, and they looked awful. And the same thing with March of 2000, the same thing with the '08 meltdown. Tops happen, and they tend to precede a lot of these crashes if you know what to look for. So keep in mind that sentiment also comes into play, and it tends to be one-sided. When everybody's coming out saying the market's going to top, most likely the market's not going to top, and vice versa with bottoms. So for whatever reason, that counterintuitive part comes into play. Same thing with sentiment. Markets, most people tend to underperform the market. Most people are wrong. Most people miss the market. And when everybody's one-sided, realize that typically the tide's going to shift. Whether everyone's bullish, it's going to become bearish, or vice versa. Here are a few charts of the Dow Jones Industrial Average, which goes back to 1915. The NASDAQ and S&P weren't around back then, so I'm using the Dow just for the sake of looking at these tops and bottoms. The tops are red boxes, bottoms are yellow boxes. And this is a quarterly chart, so each one of these bars represents 1 quarter of the year. So as you can see, looking at this chart here, this box, this was a top. Let's say it took 4 quarters, 1, 2, 3, 4, and then the 5th quarter, it finally fell. So after a nice rally, you saw a top develop, took 5 quarters. Here, 1, 2, 3, 4, 5 before it really bottomed. And this was the roaring 20s. Look at that big, huge move. You had a little bit of a bottom happen, whatever the case may be. It was a normal pullback, but you can say that was a bottom, that was a real bottom, whatever the case may be. Again, 1, 2, 3, 4, 5, 6 quarters before the market really bottomed and took off. Now, at the 1929 crash, you had 1, 2, 3, 4, and that's when that crash happened in October. Again, that 1929 crash. But look how long it took. It took 4 quarters. It took almost 1 year before the market really topped out. Now, you had that big 1 quarter where you had the big blow-off climax top type of a move, and then it took off. It started to sell. But again, before that crash happened, you had that definitive topping pattern develop. Time. Just keep in mind, time is a huge element with tops and with bottoms. And then all of a sudden, the depression was over. And then you had the 30s come into play. You had a little bottom here. Okay, great. 1, 2, 3, 4, 5, 6 quarters before the market bottomed. A nice rally. All of a sudden, 1, 2, 3, 4 quarters. 4 quarters is 1 year. And then you had a topping pattern. Market moved sideways to lower, and then you had a nice little, I guess, a follow-through bear market happen. You had another 3 quarters right there, bottomed and a little bounce. Next slide is 1941 to 1971. Tops and bottoms, same thing. You can see it. Look at these big tops. 1, 2, 3, 4, 5. 1, 2, 3, 4. And then the bottoms, the same thing. Even the short bottoms last for 2 or 3 quarters. Here's 3 quarters. Here's 4 quarters. So keep in mind that tops and bottoms need time to develop. And the reason why I'm going through these 3 or 4 slides is it shows you the last 120 years or so of the market action. And here's the Dow from 71 to 2002. And this is a huge rally for the 80s and 90s and led to the dot-com top. Again, and here's the 87 crash. And you can notice it was a 2 quarters or 3 quarters before you had that crash. And the bottom here before this big, it set up again for that big rally. Here's a 2000 top before it really led to the whole dot-com bubble. And 9/11, all that stuff was right after that topping pattern. And then the 2002 bottom before the second Iraq war came into play in Afghanistan and all that stuff. So either way, you throw the market bottom before the market started, the tide turned. So just objective in analyzing the price action, you look at the most recent period, the last 13 or 14 years here. Well, this goes back to 96, so almost the last 18 years. You have a decent amount of time where you say, okay, major tops take time to develop. Here we are right now. So you need some time if you're going to develop a top, and it could top out here. No, eventually it will top out. Bull markets are followed by bear markets, and bear markets are followed by bull markets. It's just the law of nature. So be cognizant of the fact that you need for a proper top to develop. Those of you that are interested in other markets, look at the NASDAQ 100. This is a QQQ, and the same thing here, where the NASDAQ 100, interestingly enough, has not recovered from that 2000 top. Was the Dow and the S&P are now at new all-time highs. Here's a 2000 high in the Dow, which we'll get to the S&P in a second. But the NASDAQ has not fully recovered just yet. So it still has some more room to run just before it gets to the 2000 top. But understand, it's a quarterly, same thing. It takes time for these tops and bottoms to develop. Here's a chart of the S&P, and it goes back. Here's the top in 2000. Here's the top in 2007. And here's where we are right now. And here's a valuation standpoint. Look at the S&P. 29 was the PE when it topped out in March of 2000. That was a dot-com bubble, and you had a huge valuation expansion. PE ratio in 2007 was 22, 2008, and now you're at 18. So you're fairly valued from a valuation standpoint. Look at volume, how volume just dried up during this whole rally. But it doesn't matter. You're still up 180%, if not almost 200% from that March 09 low, which was right here. So that's why, for me, volume is just a secondary indicator. The market's going straight up, and then volume here is going straight down. So that's why, for me, price is primary. Everything else is secondary. Thank you very much for attending tonight. We have a lot of questions of what we do. We offer 3 basic services. We offer asset management, separately managed accounts. We offer institutional advisory service. If you're a professional money manager and you don't have access to research in the big bank and you want independent ideas, feel free to contact us or check out analyzewallstreet.com. And then for individuals, we have FindLeadingStocks.com, which is a weekly stock market report, has intra-week updates, gives you specific buy and sell ideas, when to get in, when to get out, how much to risk, every weekend before markets open. This way you have a clear plan on what to do, and there's no confusion in the middle of the week. Simply visit FindLeadingStocks.com if you're interested in learning more. We will be having trading courses coming soon, so stay tuned for that. And our contact information, if you're looking for Adam, it's on visit FindLeadingStocks.com or email info@FindLeadingStocks.com. Mike, thank you very much for putting this together, and that's his contact information. Definitely check out recommending and joining ChartYourTrade.com. A ton of great information there. And Mike's email address is lamont.mike@chartyourtrade.com. Thank you once again for joining, and we'll see you soon.
Thank you all for watching, and we hope that you enjoyed this video. If you were watching us on YouTube, please take a moment and click the like button here at the bottom, and also take a moment to subscribe to us here on YouTube. If you'd like to try out Adam Sarhan's Find Leading Stocks service and see all of these concepts in action, visit findleadingstocks.com and save 10% off of any membership level when you sign up. Simply go to findleadingstocks.com, enter discount code CYT, and claim your 10% discount. Thanks again for watching, and have a great day.